Let's now bring in Scott Nations, President and Chief Investment Officer of Nations Indexes. So maybe we'll start, Scott, with this Diamondback energy trade. Consensus trade for energy overall. Is this one that you'd be a buyer or seller of, given the dollar headwinds or tailwinds that you see?
Dom, I love that. Let's cut to the chase. I'd be a buyer of Diamondback. Even though it's 28% below its 52-week high, now that crude oil is rebounding, it's up 5% today, back above $100 a barrel. That's going to be great news for somebody like Diamondback. Energy is still insanely expensive, even though crude oil has pulled back a little bit. Let's look at some of the technicals. The one technical I like to pay attention to is relative strength index. So even though I'd be a buyer of Diamondback, from a momentum point of view, we can actually buy it at a relative discount, RSI of 38. But it all comes down to earnings, and the expected EPS for the current year for Diamondback, $25.15 a share for stock that's trading at $1.16. So we're talking a single-digit PE ratio. We know that those sorts of earnings are not going to continue, so that PE is going to come back down to earth. But again, energy is going to be insanely expensive for the next, insanely profitable for the next couple of years.
All right, so that you're a buyer of. What about Southwest?
Southwest is a very different animal. You know, they're hurt by the fact that energy prices are so much higher, even though they're best in the business when it comes to hedging. They're only 34%, about a third below their 52-week high. So they've not been hurt that badly. But every airline is being killed by capacity constraints. We saw more people going through security in the United States, airport security in the United States on the 1st of July than they did the 1st of July in 2019. So we're all trying to fly now. On Friday, 29% of Love's, that is Southwest flights, were delayed. So they have a real problem as far as capacity. It's the best name in the airline space, so I don't want to be a buyer. If I did have a loss in Southwest, I would be harvesting that loss. I would be harvesting it. I would be waiting well more than 30 days to make certain we don't have a problem with wash sale. But then I would reevaluate. And if I want to get back in the stock, if I still liked it, then I would be a buyer. But right now, I think it's a sell for tax reasons.
All right. And the last one here is Ulta Beauty. We're talking retail for personal care and cosmetics and perfumes and colognes, that sort of thing. We're getting out more, Scott. We want to be more social post-pandemic. Is Ulta Beauty one that you'd want to buy? It's already down 7% so far in 2022.
And, Dom, we all want to look good when we go out. It got killed. This company is a great story, a great niche, great brand, but it got killed in August of 2019, well before the pandemic, because of some really disappointing guidance. At the bottom of the pandemic low was down 60%. This all started with EPS disappointment. It's now bounced back all the way, made a new all-time high at dollars a share. But the problem is inflation. Agree that the stores and the products are seen as a luxury. I think they're going to have a really tough time with inflation. They may end up being the first thing that people cut. So again, I love the store, I love the brand, but it's just not the time to be long Ulta, and I would be a seller.
All right, those three stock picks in our three stock lunch. Scott Nations Indexes. Thank you very much, sir. Have a good day.
Thanks.
Shepard Smith here. Thanks for watching CNBC on YouTube.